Welcome to another episode of our video series of the critique of modern systems.
It's good to be back.
How have you been?
Good, thanks. And, this topic we're tackling today, it feels more relevant than ever.
It really does. We're going to get into one of the most, perplexing topics of the modern financial age. The incredible rise of cryptocurrencies, specifically Bitcoin, and the huge systemic fraud that just seems to follow it everywhere.
It's a crucial topic. And the sheer scale. I mean, when you look at the recent crises, the allegations of billions collected, 350,000 people affected, we are so far beyond simple market ups and downs.
Exactly.
This is a really profound tension between a genuine financial idea and just, spectacular human and regulatory failure.
And that's what we want to analyze today. What this whole phenomenon tells us about our modern systems, and maybe even more what it tells us about us, human nature. So we need to understand the fundamental need that even created these currencies, and then somehow trace that path from a utopian ideal straight into, the darkness of deception.
Okay, so let's start at the beginning. The origin. What was the core idea, the rejection that gave rise to something like Bitcoin?
It was a rejection of centralized state authority over money itself. If you really look at traditional currency, the cash in your wallet, it's essentially a promise.
An IOU.
Exactly, an IOU. It's a debt note, a liability the state holds against its citizens, and the government completely controls the supply.
And the crypto pioneers wanted a way around that, a peer-to-peer system that sidesteps that ultimate power structure because fundamentally, they didn't trust the custodian, and they were on to something. The concept, the technology is monumental. Some economists even think this could be the seventh form of money humanity has ever created.
Wow.
But here's where the theory hits the real world. Most of the thousands of crypto assets out there, they're not being used for peer-to-peer exchange, to buy a coffee.
No.
They're treated almost entirely as speculative savings vehicles.
Yeah.
And that pivot right there, from utility to speculation, that's the beginning of the problem.
And it's funny, even the word itself, crypto, it sort of hints at a weakness, doesn't it?
How so?
It literally means secret thing, hidden. So if your basic medium of exchange requires some kind of specialized code-breaking knowledge, you immediately create an information gap, an asymmetry.
And that asymmetry is always, always exploited.
Which leads us to a really fundamental economic point. If we're asking whether Bitcoin can truly replace traditional money, we have to look at the established criteria.
Right. Money needs to do four things, and this is where the whole argument it falls apart, doesn't it?
It does.
So it has to be a medium of exchange, a unit of account, a reliable store of value, and a standard of deferred payment. Bitcoin, it does the first one okay. You can exchange it.
Yeah.
But it fails spectacularly on the others.
And the main reason is just the raw volatility. The lack of stability.
Yes.
You can't use something as a unit of account to, say, measure the value of a car or a college education if it swings 30% in value overnight.
Think about what a central bank is supposed to do. Its main job is maintaining price stability. If it fails, you have no idea what a loaf of bread will cost next week.
Right.
I love this analogy of the measuring tape. Imagine you have a 50-centimeter ruler you use for everything, but tomorrow, that ruler might just shrink to 10 centimeters or stretch to a full meter.
You can't build anything.
Exactly.
Yeah.
You can't maintain any rational relationship with value if your measuring tool is always changing. And that's why crypto is, for now, stuck in the world of speculation.
And that instability, that's what made regulators so nervous from the start. It wasn't just about protecting their own currency. It was because its first major use case was, frankly, for crime, for money laundering, buying weapons, drugs, all these underground transactions, so of course they were cautious.
Precisely. And the thing is, while the technology feels brand new, our human vulnerability to this kind of financial fraud, that's as old as time.
That's the perfect transition, because you shared this amazing historical anecdote with me from the Ottoman era. The whole idea of dolap severmek.
Yes. So in the Grand Bazaar, the sarafs, the money changers, they operated from these tiny secretive rooms called the dolap.
A dolap, okay.
They were the only ones who really understood the complex finances of the day. So they effectively kept the general population, even the military, confused. And in times of monetary chaos, they thrived in that secrecy.
And when things stabilized,
they'd emerge with all their wealth. And that practice gave birth to the Turkish phrase dolap severmek, which basically means to turn a scam.
That is just a stunning parallel to a modern crypto exchange. A high-tech, opaque secret room where insiders thrive on complexity and volatility.
The tools haven't changed, just the technology. You have to contrast the different kinds of financial crime. A robber uses force. A fraudster. Their weapon is persuasion.
Trust.
Trust. They gain the victim's trust by being in constant supportive contact. So many of these platforms, they act like they're your friend, your partner, guiding you to riches.
And they all use the same old playbook. Celebrity endorsements, fake testimonials, big marketing budgets, and the one big hook. The promise of instant, easy returns. So why? I mean, why do hundreds of thousands of people, despite all the warnings, still walk right into that trap?
It connects to some really deep evolutionary psychology. Scammers prey on the part of society that is desperate for instant, risk-free profit. We have this ancient, hardwired impulse to hoard resources the second they appear because we fear future scarcity. That drive to get something for nothing, it just overrides our rational judgment.
So if you're actively looking for free money, you've already made yourself the perfect target.
You're the perfect target for someone selling the illusion of a golden opportunity.
Which brings up the institutions, the watchdogs. If this is such an old problem, why did our modern financial guardians fail so badly in this recent case? With all those victims.
You know, we don't even have to look that far. We had huge banking crises in the 1980s. That forced the state to create things like the Capital Markets Board, the SPK, let's call it, back in 1982.
A market regulator.
Right, to regulate financial trading. But even with that history, we still see these massive Ponzi-like schemes pop up every single decade.
And the core problem now is that there's no regulatory parity, is that right?
That's exactly it. These intermediary companies, the ones that let you buy Bitcoin, are just shockingly unregulated. We don't know who owns them, what their qualifications are, if they're even licensed.
He's incredible.
Think about this. To open a barbershop, you need certificates, government oversight.
Yeah.
For hygiene, for professionalism.
Sure.
But anyone, literally anyone, can start a crypto exchange with just a website and an ad budget and start handling billions of dollars of public money. The regulatory barrier is lowest where the risk is highest.
We did see the central bank do something recently, right? They banned using crypto for direct payments.
Yes, but it was a very low-level regulation
Yeah.
from Yunit Melik. They argued that letting a hotel, say, accept Bitcoin for a room undermines the national currency.
Which feels like they're missing the point.
It's a delayed, fragmented approach. They're treating a symptom, the payment mechanics, not the fundamental disease, which is the systemic risk in the unregulated exchange platforms themselves.
So the real danger isn't just the $2 billion that was already lost. You're suggesting that because institutions like the SPK are failing to regulate this properly, we should expect much worse.
I think we have to,
Yeah.
yes. The vacuum created by a lack of rules will always be filled by opportunism.
Which brings us to a question I think a lot of people have. If crypto isn't real money, and it's not backed by anything, where does the value come from? Why does the price go up?
It comes from one place, pure arbitrage. It's a system driven entirely by demand and speculation. You buy it low, hoping someone else, the greater fool, will buy it from you higher.
There's no actual production.
Nothing. No economic production, no dividend, no rent, no physical asset behind it. You're just buying into the story that it will keep going up.
So what we've done is we've taken fiat money, which is already a kind of collective story we agree on, and we've layered a second non-productive story on top of it.
That's a terrific way to put it. A speculative narrative layered onto an accepted one. And any model like that is inherently unstable because your entire investment depends on a price that has no rational, object-based explanation.
You can't point to a factory or a piece of land.
Exactly. It's just a hot potato. And you're hoping you're not the one holding it when the music stops.
So if the old models, the Industrial Revolution models that lean on banks, can't solve these new information age problems, what's the path forward?
The alternative is actually quite clear. We need robust capital markets. The SBK needs to evolve from just being a fraud police force into an institution that actively creates a safe, effective environment for the nation's savings.
And if you can channel all those small savings through regulated markets, the benefits are huge.
Enormous. It creates a partnership culture. The real economy, the companies making actual things, they get funding directly from the public, not just from expensive bank loans. It builds resilience.
There are global examples of this working.
Of course. Japan rebuilt its entire economy through its capital markets. The U.S. funds the most radical innovation satellites, biotech, by pooling small investments through the market, through angel investors, not bank credit.
So this crisis we're seeing, It's really about ordinary citizens trying to protect their savings from inflation in a vacuum. And that vacuum pushes them into these incredibly risky areas.
And we have to understand the true cost. That recent $2 billion loss, it's not just devastating for those 350,000 people. It's a blow to the entire national economy.
In what way?
That amount of capital, if it were used productively, could fund a major world-class university for 20 years. That is the staggering opportunity cost of unregulated risk.
That's a powerful perspective to end on, and maybe a final thought for anyone listening. If your primary drive is for instant, unearned wealth, you are consciously making yourself a target. Knowledge, producing actual value, and patience, and we're talking a minimum of 3 to 5 years for logical scientific returns, that's the only sustainable path.
Trying to find a shortcut, to defy those principles. It's like trying to defy gravity. The old wisdom is true for a reason.
And what's that?
Free cheese is only found in a mousetrap.
A profound truth for the modern age. Thank you so much for this analysis today.
My pleasure.